Hi there, this is Jared Moyer with Bankers Compliance Consulting, and I want to welcome everybody to today's program. This is our Compliance Forum. This would be the January 2021 edition. We're about 10 minutes from this top of the hour, and we're going to do a little bit of housekeeping, and then our team is prepared to let you know about some of the exciting things that we've been working on to help you as you meet those compliance challenges in the coming 2021 year. So let's do this. Let's first make sure you've got the materials. There's not a lot for today's program, but we want to make sure everybody has them. So I'm going to put a slide up on the screen. Bear with me just one moment. There we go. If you notice on your screen, in addition to seeing similar to what's there, you're going to see a control panel that has several buttons on it. One of those buttons I want to draw your attention to immediately here, and that is the chat button. If you, for some reason, didn't get the email, no fear, we're going to help you out immediately. There is a link that if you click on that chat icon that will take you to the outline for today's program. Now, the outline essentially is some information about some resources, some tools that you can go and download for yourself at no cost, some information about upcoming products and services that we've put together to help you and your team, as well as some pages for you to take notes. Now, maybe you don't have this thing printed out, don't have access to a printer. I tell you what, a trusty notebook will do. We simply want to make sure that you are taking some notes along the way. Now, this is going to be somewhat of a quicker paced program. You might be going, how am I going to keep up with that? It's being recorded and at no cost to you. You'll be able to download it and hit pause, fast forward, things that don't interest you, things that do interest you, you'll be able to rewind and hear them again. We'll let you know more about that recording as we get towards the conclusion of today's program. So again, click on that link in the chat icon. Now, while you're looking at that Zoom control panel, let me give you one more thing. There's several other buttons, but another one that's going to play a huge important role today is going to be the Q&A button. It's how you're going to communicate with us. Hey, Dave and I are going to take questions. Diane's going to give them to us. How you get those questions to us, you click on that Q&A button, type it in. You can start doing that. We've had several people that have pre-submitted for today. We're going to tackle those, but we've also got some time set aside where we're going to tackle questions live from the field. So go ahead and start typing those questions in using that Q&A button in the Zoom control panel. All right, I'm going to cue Dave up here for a couple of things that we've got coming up on the agenda as far as trainings in the 2021 year. Dave, why don't you tell us a little bit about that truth in savings training?
All right, not a new reg, not a lot new. It seems like people forget, that's what I like to say. And there's always been this confusion about compounding and crediting and things like that. And we're seeing some banks that are getting criticized for this. So we put together this program, 1 hour. Going to get in there and get out and explain it. Be a great resource for your new hires as well, things like that.
All right. And right on the heels of that one, we've got another one coming up. This Thursday, we're going to be doing Auditing TRID. Very popular webinar year in and year out since TRID came into place. It's a different perspective. Rather than looking at it from the lens of the loan processor or the lender, we're going to take and tackle things from the auditor's point of view. We're going to tell you what our team looks for when we go into your banks and do compliance reviews and try to check those boxes along the way. So check it out. If that's not you, pass it on to those auditors and those reviewers on your team and have them join us for Auditing TRID. Now, Dave, I want to cue you up for the senior management or the compliance management and board training, if I can.
Yeah, and I can tell you what, this is one of those that when I teach this, the number one response we get is, oh, I wish that my directors were here. I wish my management was here. Get them here. So get them to come watch this. Now, again, 1 hour, or get it and then show them certain aspects. What we're going to talk about is what's the role of the board? What's the role of the senior management in the compliance and holding people accountable? And does the risk assessment that you're developing, does it match up to their risk appetite? Because they're the ones that really should be deciding that. And for them to record that in their minutes and be on board and that you're all in unity together. It's something I could just go on and I don't have time right now, but I'm very passionate about this topic and we've got to get your senior management boards to watch this thing. So drop them a note, tell them that we got the delight guarantee, that if they're not absolutely delighted, they don't have to pay anything. Somehow get them to come, entice them. I don't know, take them out to lunch and then trick them. They're going to be watching this instead. So anyway.
I tell you, you know what, one of the things I love about this is this is the 1 hour short and condensed version of this. You've got a series that you do as well, right? Maybe sneak that in there if you can.
Yeah, there's a 6 hour, 6 part compliance management series. And we start with this. This is the role of the board and senior management. To me, it's the roof of the house, if you will, the house of compliance. And then we go through risk assessments and go through the role of the compliance officer. We go through training and auditing and monitoring and complaint management and reporting, and then culture, obviously a big one. And so this is just 1 hour in a sense that's talking about the role of those senior people and making sure that you're all on the same team. And that really is a large part of that. So, but yeah, there's also a 6-part series that has been really well received. And I feel like, Jared, I got to be an old guy. It's 30 years in this industry that I feel like I'm bringing to this table when we talk about this.
I can say 20 now. I couldn't say that a couple of years ago, but even I can say 20 now. That's crazy.
You got to have some gray, a little more gray there. You might want to,
I'm working on it. I'm not quite up to your standards yet, but I'll get there someday.
You do have some teenagers. You'll be getting that gray. Okay.
That's right. I got my first one and 2 more to come. Let me do this. We've hit the 175 mark, and we've got 650 plus registered for today. I want to make sure that you know where you're at if you just joined us. We haven't started yet. We're about 5 minutes from the top of the hour, but you're in the right place if you're looking for our compliance forum. Today's version is the lending version. We do these forums 4 times a year. I want to make sure you've got the materials for today's program. So if for some reason you don't, you can navigate to the chat button in the Zoom control panel. Our team's placed a link there. It will look a lot like, let's see, I'll find it. Here we go. It'll look a lot like that link that you see there. Click on that. You'll be able to download the materials. Some information about products and services that we have available through our website, as well as a place for you to take notes. And again, if you don't have a way to print, trusty notebook will do. We simply need a way for you to take notes along the way. Now, I've got a couple things I'm going to queue up here that we've put out recently based on some final rules that have dropped. And I think we're going to have to get used to that. This new administration, they're going to be dropping things as far as final rules and guidance and Q&As, I think pretty frequently in the coming months. So strap up there. But we've had 2 rules drop in the last couple of weeks, or last month and a half, I guess. The first one was but let me tackle the most recent because it's the one we're going to be doing sooner than later. That is the new HPML rule. It dropped. We're waiting on the effective date because it hasn't been published in the Federal Register yet. But they've added a new exemption to those of you that are escrowing for HPML loans by way of the current rule. Some of you may get out based on this new rule. We're going to do a 1-hour webinar on February 17th on these new HPML requirements. So join us for that, or pass that along to those in your team that may benefit from that.
Jared, I'm going to jump in here. I'm not seeing that slide. I'm still seeing the free form, and it looks, maybe it's just my end, but I'm actually kind of like, you want to try an advanced slide and see if you get?
Yeah. Anything advanced for you?
No. So maybe it's my end.
Diane, were you seeing it?
No. I'm actually seeing
no, it's not advancing on our end.
How about now?
No, it's almost like it's 2 slides at once too. There's something that got.
This is that thing that we ran into the last couple of weeks with Zoom.
Yeah.
Not sure of the fix here. I am gonna quit.
Stop the share. And okay, tell you what, while you're
take it from there.
Doing that, I'm just gonna go ahead. We've got lots of pre-submitted questions. We also want to hear from you. And so if you go down to the Q&A button on the Zoom platform, you can start right now submitting questions. We have Diane Dean, who is moderating today. She's going to be sorting through those as well as trying to feed us questions. And she's probably got the hardest job on the team here this afternoon. But in just a couple of minutes, we'll get started. But if you have questions, you can go ahead and put them in there. Use the chat button to talk to our administration team about audio, visual, things like that. Use the Q&A button to talk to Jared and I, and really through our moderator, Diane Dean. So, all right, Jared, let's see what we come up now. I'm seeing a black screen. It says you're sharing.
Nothing?
Nothing, no. This is always fun.
Yeah. Well, the good news is the slides are not a huge part of the presentation.
I was just going to say that. The slides are really the icing on the cake for this presentation. They just bring up, so maybe we just want to have it so people can toggle in the view mode and put it on speaker, or put it on the Brady Bunch mode. I like to call it gallery.
Yeah, and I tell you what, we've got just about 30 seconds here, it looks like to me, before we go live. I want to finish that thought I was sharing with everybody, because kind of left everybody hanging.
QMs.
The new QM rules dropped, I think it was December 13th. That's going to affect any of you that do any sort of secondary market or investor lending. The game is going to change as far as the QM status with those loans. You're going to need to be in the know there. Our team's going to be doing a 1-hour program on those new QM rules on March 9th, and we'd love to have you join us and get the background on that so you can start your implementation plan. It has a July 1st requirement as far as the go date for that, and we'll get you all taken care of on the ins and outs as it relates to that.
Yeah. And we're getting some links in the chat area there too. So if you're looking for that. Yeah.
Well, team, I have that's top of the hour, and I want to make sure we get to as many questions as we can here. So I'm going to formally welcome everybody into today's program. This is the Compliance Forum. We do this 4 times a year. The first 3 are Q&A installments. The third one is a look back and look ahead. Today's is going to be the lending compliance Q&A. And if you've got lending questions, a lot of your peers have already pre-submitted, and some of them have even hit the Q&A box up to type them in live here. We're going to get to as many as we can today during the 1-hour time frame. This is being recorded, so if you need to go back and listen to something again, you'll be able to do that, and we'll tell you more about how that works at the conclusion of today's program. My name is Jared Moyer. I'm going to be one of the presenters today. I'm joined by Dave Dickinson and Diane Dean. Together, we're going to tackle your questions. Diane's going to play that role of moderator. There's a Q&A button in the Zoom control panel. Go ahead and start typing in those Q&As, and we'll try to get to as many as we can. With that, Diane, I'm going to turn the floor over to you. You're going to lead us through this, and we're ready for their questions.
Okay, we'll start off with an appraisal question under Regulation B. We had an appraisal completed on a real estate construction loan, but the appraiser did not get the appraisal to the bank until 2 days before closing. Is there any way to complete the closing on time without a violation to the ECOA appraisal timing requirements?
Based strictly on the facts presented that they're finding this information out, that the appraisal didn't come in until 2 days before the planned closing, there's nothing you can do other than to push closing out or purposefully violate the rule. And that's going to be a risk thing that you'll have to tackle for yourselves. Had this been 3 or more days out, we could have had the borrower possibly waive this requirement. They'd have had to do that on their own. We could have brought them the option, but with the facts presented, it's a violation or we push closing back.
Okay, we'll go to TRID. If the seller is responsible for the payment of real estate taxes, are those amounts still disclosed under Section F, prepaids, or are fees disclosed in this section only for borrower paid fees?
You know, this is something that we get questioned on just about every time we do a live presentation, whether it's in person or whether it's through the web. You know, do I have to disclose something that's really the seller's responsibility and the seller's ultimately going to pay? Does that have to go on page 2 of the borrower's closing disclosure? And the answer is yes, you cannot omit anything. In fact, the CFPB came out in 2020 with some Q&As that really put the final nail in the coffin and that said, hey, we meant this all along. You need to disclose these items. TRID does not allow you to omit them. They must be disclosed to the borrower on page 2 of the closing disclosure. And then just a bonus here, the loan estimate, you wouldn't have to disclose any of that because that's only about the borrower's fees. But the closing disclosure side of thing changes the game. It requires everything to be disclosed to the borrower, even if the seller's paying it and if it's not a borrower responsibility as far as the charge is concerned. Tell you what, I'm going to take a moment here. TRID training, we have a lot of different varieties that are coming up on our calendar that are also available on demand. If you're looking for some TRID training, we've got, again, a variety of it out there. If you're familiar with our website, bankerscompliance.com, you can navigate to our store and check some of that stuff out or give us a call. We'd love to pair the right training with you and your team.
Okay, flood insurance. If a developer is constructing several multifamily buildings, 5 units per building, the amount of flood insurance he needs to get is $500,000 on the entire building. But once he starts selling the individual units, won't he be required to get flood insurance on each individual unit once all the units are no longer in his name?
Yeah, this one perplexed me a little bit. So I'm thinking if it's an apartment complex, how do you sell individual units, which makes it sound like it's a condominium. So really the trick here is what is these buildings that they're talking about? Are they apartments or are they condominiums? And if they're apartments, you're right, 500,000 maximum. And then, but I've never heard of anybody selling a unit in an apartment. So if it's something that can be sold, that sounds like a condominium, which that tells me you should be buying 250,000 per unit. So what I would recommend is go to your agent and have them classify this thing. And it could be that it was, and there's changes to it and things like that. So I don't know that I can give you the exact answer. I can tell you that I've never heard of anybody selling an apartment unit. If you're selling them, it's probably a condominium, and then it isn't 500,000. So, Jerry, we do have a question I'm going to bring in right now because the untimely death of Hank Aaron. But do you have Hank Aaron over your shoulder in any of those baseball cards? Is one of the questions.
I don't. The cards there are probably from the late 70s on. I think Hank was retired by the time
Okay.
by the time I gathered cards for that. So that's a
I
really
just had to
important
sneak
compliance
that one.
question. You bet.
I had to sneak that one in.
I
Sorry.
love it.
Okay, back to TRID. When a rate lock expires to the borrower and we will honor that rate lock and those fees, does there need to be an updated loan estimate provided with a new rate lock expiration date on it? Or can we just issue the closing disclosure to the borrower since the fees have not changed?
So our rate lock expired, and we're going to just say, hey, Dave, you know what? We don't need to execute a new one of these. Our word is good. We'll give you the rate that we originally had through that rate lock agreement, even though it's expired. And so do we have to provide a new LE? And the answer is no. When you provide the closing disclosure, that'll update everything. That'll be the rate that you're providing. There's no requirement there. Had you not been locked and moved to locked and didn't anticipate the closing disclosure going out for more than 3 days, then you would have to provide a loan estimate. Otherwise, you don't need to. You can just rely on the closing disclosure.
Okay, this is kind of just a general lending question. If a customer wants to refinance a contract for deed on a property that is their primary residence and also a business, is it considered a consumer or business purpose? The original contract for deed is in the client's name and does not mention the business name. The purpose of the loan is to buy out the contract.
Yeah, and I hate this answer, but it depends. What I would do is I would look at, is it primarily residential? Is it primarily horse, stables? What's the value of the house versus what's the value of the stables? And maybe there's some other outbuildings. And you need to decide and put it in one or the other camp. And if it's a $800,000 house and $400,000 for the horse stables, then it's residential. Look at the 50-50 rule. Really, this is a truth in lending, but RESPA goes right along with it, that kind of thing. Just look at truth in lending. I want to say it's subsection 5, gives you some examples. So figure out where the 50% or more is at. And then here's the thing I always say, slam the door. Don't leave this open for debate. Say this is a consumer loan because, or this is not a consumer loan because. Tell your story, and then that way examiners don't necessarily pick it apart. So.
Okay, we'll have one on fair lending. What do you recommend that community banks do to prepare for the anticipated increased scrutiny on fair lending? Our manual reviews are cumbersome and make it difficult to accurately draw meaningful conclusions. We are primarily a commercially focused bank with a low number of consumer credits.
I'm going to pick this question apart a little bit. So one of the beginning parts of the sentence or the question was for how do we prepare for this anticipated increased scrutiny in fair lending? And some of you may go in, what do you mean? Where's that coming from? Well, we have new leadership as far as the president is concerned. We have new leadership at the CFPB. Day one, Krenger walked out. We're going to have a new leader there. And everything I've read on CNN, CNBC, things that are written by lawyers that do compliance, and other people like us that do what we do for a living, fair lending and the emphasis being placed on it is up in the top 3 of the to-do list as this administration moves forward. So that's where the question really probably stems from. Step 1, what would I do? I can tell you, let's try to make it simple for you and allow us to do that. I want to say 2 weeks ago, we put together a 2-hour fair lending webinar where we go out and we tackled all the latest, greatest guidance to date, put it together for you in one place so that you can apply the things maybe that you haven't and build that better mousetrap. I'm sure you're doing something in the realm of fair lending, but let us guide you. And through that training, we do that. Now, to answer the specific question, training, I started with that. But the manual reviews of files, I mean, you can choose not to do that. You can choose to outsource it. But when you're not doing some sort of monitoring when it comes to fair lending, it's like you're sticking your head in the sand. It's not a matter of if, it's when you're likely to have issues there. So I think you need to be doing something proactive to work towards what that goal is that's coming, that is greater scrutiny in this area. It says we're primarily a commercial bank. There's a lot of fair lending coming down the pike with commercial loans. The Dodd-Frank 1071 is just one of those big ticket items that's going to put the microscope or the magnifying glass on fair lending in the commercial lending area. It's something that's often overlooked. There's this misconception out there that fair lending is a consumer only thing, and it's just not true. It applies across the board to all credit. And we're very soon going to see, again, that microscope with the commercial lending areas. So credit cards as well to kind of finish out the question there, but you need to be looking at what the expectations are based on the guidance out there and doing something to be proactive. Sitting by is not going to get you where you need to be here.
Okay, we'll move back to TRID. Our online application portal requires customer payment for their credit report at the time of application. We have customers that have frozen their credit report and don't unfreeze it prior to the application, which results in an invoice for a credit report for the bank without any information. We communicate that they have to unfreeze their credit and pull another credit report and charge another fee. Are we allowed to charge the customer for the second credit report fee not disclosed on the first loan estimate?
Yeah, locking down your credit history comes with some benefits, but also some things that kind of work against you as a consumer. Because if you've locked down your credit by way of a freeze, your credit report, and a bank pulls it, they're not going to get anything. Is that the bank's fault? I say no. So to answer this question from a TRID standpoint, this is a changed circumstance. And yeah, I absolutely believe you'll be able to charge them after you go back and say, hey, Diane, I see you froze your credit. You didn't tell us that. So we got a blank report. If you want to move forward, we got to pull it again and we're going to charge you again. I mean, that's really on you to let us know that. So absolutely a changed circumstance. You'll have to follow the 3-day timing, but you'll be able to charge that customer.
Okay, HMDA. We are not a HMDA reporter since we do not make the required number of qualified loans. What documentation do we need to maintain to prove to auditors and examiners that we are not subject to HMDA reporting?
Well, you don't have to prove this, but it's certainly nice if you do, especially if you're close to that bubble of 100 on the closed-in loans. So what I would do is have a SMART report. What you're trying to prove is that you are less than 100 originated. We don't care about applications when it comes to the test of are you subject to HMDA? It's originated loans. So did you make 100 originated closed-in loans that would be subject to HMDA, or 500 open-in lines of credit? And it could be that you report lines and not loans and loans and not lines, or both, et cetera. Now, I also want to point out next year, a year from now, that 500 lines is going to drop down to 200, and that's going to grab some of you. So make sure that if you're trying to say we're below that, I guess, and you're close, you probably want to prove that. So I want to throw out one more thing too. If you have questions that you want to pre-submit or you want to submit now, don't use the chat function, use the Q&A button. That's what Diane Dean is watching. Our administration folks are watching the chat function, and they're putting up some links to things that go along with some of the training we're mentioning, or any audio or visual things. So questions for Jared and I, Q&A button, please.
Okay, we have one on Hpmls. We had an external audit that recommended in the cases where we do not lock the rate, the date used for the Hpml calculation should be the date of the final closing disclosure. We currently use the loan estimate date. I'm wondering if you have seen this issue come up recently elsewhere. Ultimately, what date should the bank be using for the rate spread? We honor rates as listed on the loan estimate, or if the rate goes down, we would align the lower rate. What recommendations do you have around this?
So in the question it asked if this is something we've seen recently. Yes, but let me say since day one of the HPML rule, we've seen this be an issue, and it really hasn't ever gone away. What the rule says is you're supposed to use the date you set the rate with the customer. And since day one, we've had banks that have had trouble with this because they've said, well, it'll always be the loan estimate. It'll always be when I meet with the customer. It'll always be with the closing disclosure. And I tell you what, when auditors and examiners hear that a bank's trying to make this black and white, that it'll always be this date or always be that date, it's really like game on. It's like challenge accepted, because what they're going to do is go try to prove you wrong. They're not all like that, but that's really the mentality, is that, all right, you're making this black and white. Let's go talk to your loan officers. Does every loan officer wait to set the rate until we get to the closing disclosure or the loan estimate or some other fabricated date out there that we can draw a line in the sand and have? Now, I like the idea. We struggle to make it work in practice. It's probably the most important to make sure you get this right if you're a HMDA bank, because not only do you have issues with the HPML rule on possibly not getting the correct rate spread, but you report that rate spread if you're a large reporter for HMDA. So if you don't get this right, it could cause your HMDA data to have an integrity issue if you're a large filer for HMDA. So there's a HMDA implication there as well. So yeah, this is an issue we see. It just simply needs to be the date you set the rate the final time before closing. And that could be, when Diane was in the office, we shook hands and that's when we said it. And it didn't change between there and closing. It could be the loan estimate, could be the closing disclosure. It's just, you have to document the correct rate, because those HPML rates that are based on the average prime offer rate, they change weekly. And so if you got a Friday, Monday difference, it could cause your rate spread to be different.
Okay, this next one is on the open-end periodic statement requirements under Regulation Z. I know that the commentary specifically states that if the points, loan fees, and similar finance charges related to the opening of the account are paid out of the first advance from a HELOC, these fees have to be disclosed on the first statement as part of the finance charge. But what about a consumer open-end non-home equity line of credit? Nothing that I can find in the regulation or commentary distinctly states those fees have to be disclosed when paid from the first advance.
Well, a couple of things. I love this question that it was submitted ahead of time in writing so we could study it and I could do a little research. I also love it because just this month, January, we have a thing called the Monthly Connection. It's our online virtual peer group. It looks a lot like what you see here. This is one of the questions that was actually, it was a similar question, I guess, submitted by one of our members. And you could be a member if you're not familiar with our Monthly Connection. Our team's standing by. They can give you a sample of it, but we'd love to have you check that out and be one of our virtual compliance our virtual compliance peer group members. It's the Monthly Connection. Anyway, we tackled this question, so it's something that was right at the top as far as answers. And the answer is the CARD Act really is what spelled out this rule. Now, I know the question is about non-HELOC and it doesn't talk about credit cards, but for those non-HELOC transactions, the periodic statement requirement mirrors that of the CARD Act, which states that you need to list all of the fees and you got to itemize them. And then there's a separate box that has to do with interest charged, and then yet a separate area for totals year to date. If you're looking for a sample of that, it's in appendix. It's in the appendix to Regulation Z. It's Appendix G, as in golf, 18A as in apple, G18 Apple will give you how those fees need to be itemized.
Okay, what areas or topics do we need to focus on to prepare for compliance exams?
All of them. If you're asking what's hot, boy, this can be, it really depends on regulatory agency, regional office, even field offices have different hot buttons that they're pushing at. But from my perspective, I wrote down a few things. Fair lending, and we've already mentioned that several times. The OCC often is big on Fair Credit Reporting Act and FACT Act more than the other regulators. I see that a lot on theirs. Flood, TRID, UDAP, and I would add HMDA if you're subject to HMDA. Now, there's more. I mean, again, it depends on these things, but look at your last independent audits. There's another thing. The examiners are going to look at your audit. Where have you had problems? And what did that reveal? And Jared just mentioned it about our Monthly Connection, but if you're in some kind of compliance peer group, ask the other members, what are they seeing in your neck of the woods? If you're not part of a compliance peer group, or even if you are, we have a thing called the Monthly Connection where we get together and we discuss those types of things. And a lot of the members every month will share, we just had an exam, here's what they looked at, here's what they focused on, and those where you can find help for those kinds of things.
I'm going to add just one thing to it if I can. And it's kind of it's a really broad brush, but anything that intersects with COVID and loan servicing, that's going to be a hot topic item. They're going to want to know what you did, and be careful of that grace period because it's not unprecedented anymore what's going on. And so I'm not sure how long of a grace period we really have here in our industry with exams that are 12, 18 months down the road.
Okay, another HMDA one. We originated 93 reportable loans in 2019. Since the rules changed in 2020, wouldn't we have to originate more than 100 loans for 2 successive years before we have to report again?
I can give you a very short answer. Yes.
Okay, fair lending. Are there any fair lending issues when the bank secures a loan with note receivables, which note receivables are secured by primary dwellings? And does it make a difference if we do or do not take an assignment of the deeds of trust? Okay,
so let's stay in the fair lending here because came from a specific state, obviously, and there's state law implications there, and that's not something that's our area of expertise. This also crosses over into some safety and soundness that, again, is not our cup of tea. So let me tackle it solely from the fair lending angle. You're going to want to make sure that you're applying things consistently here. if this is a one-off and you're not applying it in other situations, that could create some fair lending risk.
Okay, this one's about the Military Lending Act. Under the Military Lending Act, does adding the bank's processing fee, lien recording fee, and VSI to a purchase money note exclude it from the exemption?
Okay, so we got to refresh ourselves on Military Lending Act. From a Military Lending Act standpoint, there are covered loans, and then there's a bunch of exceptions. Okay, there's loans that aren't covered as well, but then there's some exceptions that are otherwise appear to be covered, but they get carved out. And one of the carve outs was purchase money loans, and still is purchase money loans. And then there was Q&As that they put out to address what they meant by purchase money loans and whether or not purchase money could include add-ons, including both things that come with the vehicle, like in a purchase money transaction with a vehicle, but also things like add-on insurance, like gap insurance. And I think VSI was mentioned in the Q&A. Well, the Q&A for today, the FAQ that came out by the Department of Defense originally, I don't know if it was the original one or the second take on it, but one of them, the most recent one before it was revised, basically made it sound like if you financed the purchase money for the vehicle plus gap insurance, that made the loan covered by the Military Lending Act and not one of the carve-outs. Well, they have since, it was February of 2020, they took that Q&A, they tore it up and said it's causing too much confusion and it's actually adverse to the service members and dependents. And so now it appears, even though they don't come out and say it, but the way things were reworded, that you can, in fact, finance that gap or VSI in connection with the purchase money, and it will be part of the exception to the Military Lending Act. In other words, it won't apply in that scenario. That's based on a lot of things I've read from a lot of attorneys that have interpreted that rule, because there really isn't great guidance from the Department of Defense on this.
Okay, back to flood. Can you address flood insurance requirements in connection with modifications, such as extending a loan for 30 days? If we have life of loan monitoring, can we rely on our determination company's life of loan monitoring?
You cannot. The life of loan monitoring is a service that has nothing to do with the regulations. So I know it's very common sense to think that, but that's just to let you know if a map has changed your borrower into a special flood hazard area or out. So when you have a make, increase, renew, extend, in this case, you were saying you're doing an extension, everything is back on the table for flood. Now, could you rely upon a previous flood determination? Yes. And that's where maybe you go to your current, vendor, flood vendor, and say, has there been any changes? But if they're in, you're still going to have to do a notification. You might have to escrow. You might have to make sure if they're in, you're going to have to make sure the right amount, et cetera. So you can't rely upon life of loan. Don't hang your hat on that. Start over with everything.
Okay, back to TRID. Can the APR on a TRID-covered loan go down by more than 0.25% without triggering a new 3-day waiting period?
The short answer is absolutely it can. In fact, in a lot of cases, maybe you've heard this phrase before, no wait for a lower rate. And so I'm the loan officer and Diane comes in and she says, hey, will you match the bank down the street's rate? I quoted her 3.25 and they're quoting her 3%. If I just lower the rate, there's no wait for Diane, even though the APR is going down by more than 0.25%. However, if I say, well, we can't quite match the rate, but if I charge you a 0.25% point or I charge you a fee, then I'll give you that lower rate. Then there would be a 3-day waiting period. So that's probably the short answer. And then a little bit more, there is some more to that, but it would take 15 minutes to explain it. And we go there in our TRID webinars, and I'll invite you to take a look at some of them.
Okay, this one is on HMDA and introduces some TRID. What concerns, if any, do you have on using the TRID application date for HMDA purposes?
In fact, I'm going to add a little more to this. Reg B, HMDA, TRID, 3 different definitions. So most of the time, they're probably all the same. Somebody brings you these 6 pieces of information, you probably have a Reg B app and a HMDA app, and so it's the same. But theoretically, what if you had the name, address, social security number, loan amount, and a property address? So you got 5, but you don't have the value of the dwelling yet. Well, you have a HMDA app, but you might be able to make an argument that you don't have a TRID app yet, and maybe you could go figure that out, but at that moment. What if you do pre-approvals? And this person didn't say, if you have pre-approvals, you absolutely cannot use that, because no house, well, I'm sorry, I was going to say no house, no HMDA. That's pre-qualifications. Pre-approvals, if you have a pre-approval program, you don't have an address, but you have a pre-approval app for HMDA possibly. And TRID comes later when they identify that house. And then I'm just going to throw in the Reg B part. Somebody asks, how much home can I afford? And you say none. You may not have TRID at all, but you got a Reg B app. And so understanding that these are different. So again, most of the time they probably come in the same, but I don't want to throw in to say, do I have no concerns? No, I do have some concerns with that mentality.
Okay, fair lending. From a fair lending perspective, what concerns do you have with giving discounted rates to a certain professional group, such as doctors?
We probably get a question like this a few times a year, and it's not that you can't. I want to say no, but you got to do some due diligence. And I also want to go back to, I've been saying it with just about every fair lending answer, consistency. So the professionals that you're choosing to try and give this cut rate discount to, who are those professionals? Are they a bunch of white males? Because that's going to be a problem for you. And then what about other professionals in your area? I mean, how do you define professional? Is it just doctors? But what about the attorneys in your area? What about other makeups of professionals?
Bank consultant.
Bank consultant. I mean, yeah, there's all kinds of angles here. So I tell you what, I wouldn't go here. I think there's other ways to do things, and this one creates too much risk for my taste.
Okay, HMDA. Which loan amount do we report for HMDA in this scenario? An applicant applies for a mortgage loan for $200,000, but the lender counter offers $150,000. If the loan is never made, what loan amount do we report on our LAR?
Whether the loan is made really isn't a factor here. It's did they accept the counteroffer? So if I say, Jared, I can't do 200, but I can do 150, and he says, oh, okay, then the loan amount is now 150, and we're moving forward. Now, here's what's interesting. I could still deny Jared. He could still withdraw. We could have a closed for incompleteness. We could have approved not accepted. Every action is back on the table. So just because I said 150 and he accepted it doesn't mean the loan has to close, and HMDA doesn't require that they close for it to be considered accepted. It just says, did they accept the counteroffer? So what I don't have in this question is, did they say yes or no? If they said, no, I can't do 150, then you report 200 and you would report it as a denial. But if they say, yeah, let's move forward, it's now 150, all action takens are back on the table.
Okay, this one is on qualified mortgages. Will the same rate spreads to determine whether you have a safe harbor or presumption of compliance with the QM rules remain after the new rules go into effect?
So the safe harbor that's being referred to in this question is the small creditor safe harbor for the balloon and the portfolio QMs. There's a thing that says if you're a small creditor, you can make an HPML that's otherwise not a safe harbor QM. But if you're a small creditor and the rate spread's less than a certain percentage, you can still have a safe harbor as opposed to a rebuttable presumption of compliance. Those rate spreads and that safe harbor rebuttable presumption for those QMs, the small creditor portfolio and the small creditor balloon, are not going away. In fact, they don't touch them at all. So those will stay in place. If you're not familiar with this new rule, they dropped new QM rules in December of 2020. They're going to be required as of July 1st. And you may be thinking, gosh, this maybe isn't going to impact me. If you do any type of secondary market lending, their QM that they have been using for the last 7 years is going to go away. That temporary QM, it's going to get replaced with the revised version of what has been known as the general QM that many people steered clear of because of Appendix Q and the 43% debt ratio. That's now going to be replaced. And that is what we believe the secondary market and your investors are all going to rely on, which means you have to be up to speed if you do any type of lending like that. March 9th is the date we're doing that. You can get registered today. We've got a lot of people already registered. We'd love to have you be part of that training program.
Okay, along those same lines, does the new QM rule include a new debt ratio outside of the 43%?
No, they killed it off. Basically, it's going to work like the non-QM. You're going to get to set your own internal policies as far as debt to income ratios are concerned. Now, are they going to be subjective if you ever have to go to court? Yeah. So are they going to be subjective in the eyes of the examiner when they're trying to say, here's how we determine ability to pay versus how you actually did it? Sure. but you won't be stuck with a mandatory ceiling. That's gone.
Okay, let's see here. We have one on RESPA. Can we offer borrowers a gift card for closing their mortgage loan with us?
Certainly. There's no RESPA Section 8 issues here for saying thank you for doing business. It's if you're paying someone to bring those people or fee splitting, and I don't see any issues with that. One side note, not an IRS expert, but it's $10 or more. I think there's some 1099 issues. Check with your accountants.
Okay, we have a couple on HPMLs again. Will the existing HPML escrow exemption be changing at all?
No, and this is kind of confusing too. And again, we've got some training we've talked about already. We're doing it on February 17th if you want to get really in the weeds on this. But the existing exemption for HPMLs and the escrow account that goes with them is going to stay in place. It's a little weird. They're leaving it alone and they're adding this new one that looks, walks, and talks a lot like the old one, but not quite. Different asset size threshold, different loan volume threshold, counted differently. And if you qualify for either one, you'll be a small creditor for HPML escrow accounts and won't have to escrow. I do need to caution you, you have to read real closely with the maintaining escrow account part of that calculation, because a lot of you, it'll look on paper and your management teams go, oh, we can get out of escrowing. You got to read the fine print. There's some fine print that's going to exclude some of you from this exemption, just like it always has. So it might be too good to be true for some of you.
Okay, will escrowing for a non-HPML still ruin the escrow exemption?
And that's the fine print. So that's the thing that's going to disqualify you from either one of those exemptions. That's not changing.
Okay. Are we required to switch to the new Fannie Mae application form?
And I'm going to add one more. That was a pre-submitted question. We've had some similar questions. Michael threw in one, something about we don't sell loans. So the answer to this is no. You have to collect demographic information if you're a HMDA reporter, and you'll need to use what's basically on the bottom of the Fannie Mae new 1003. But you can do that on what we call a short form. We have one of those. It's like we made it up ourselves. So you don't have to use the Fannie Mae 1003. Now, let me just stop. Unless you're trying to sell it to an investor, they're going to require it. And so if you're not selling, if you're saying these are in-house, all that, no, there's no requirement. Just make sure you're collecting demographic, not government monitoring, there's a difference, information correctly with the disclaimer in the boxes and all that.
The other thing to watch out for is if you keep any government-backed loan program products on your books, you too may have to use the Fannie Mae 1003.
Yeah, good point.
Okay, this one takes us back to those HPML escrow requirements. We meet all the exemption criteria, except we do escrow other mortgage loans when the customer requests it. This means we are required to escrow HPMLs, correct?
Well, by the way the question's worded, I'm going to say yes, but I'm going to split some hairs. And so we only escrow if the customer asks us to. If it's truly a voluntary escrow, and that's the only escrow account you hold other than HPMLs previously, and you can demonstrate that it's truly a voluntary escrow, meaning Diane can walk in and get her money anytime, no questions, then I would say that would not exclude you from the exemption. However, if you only escrow when the customer asks, but you do it like all your other escrows and they're not really voluntary and you have no way to prove that, then you're going to lose the exemption.
Okay, this one is on escrow accounts. Are we allowed to net the funds in an escrow account towards a loan payoff if the loan is being refinanced into a new loan without an escrow account?
I'll take that. And the answer is yes. It hasn't always been that way. It was a change several years ago that they allowed you to net it.
Okay. If we are doing a commercial loan where the primary borrower is an entity and there are two individual co-borrowers, does the joint intent acknowledgement need to be signed by someone representing the company and the two individuals, or do we just need something for the two individuals?
I'll take that one too, Jared, if you don't mind. You have to have someone that is authorized on behalf of the entity, in a sense, to represent the entity. So think about a corporate resolution or something like that. So if I understood correctly, you've got two individuals and an entity, or two entities and an individual. You've got three applicants here. Could be me, right? It could be Dave Dickinson as an individual, Dave Dickinson is the president of Bankers Plan Consulting, and Dave Dickinson, the president of ABC LLC, that's all applying, then I'm going to sign Dave Dickinson, comma, individually, Dave Dickinson, comma, president, Dave, that kind of thing. So there's a lot of ifs and ands into that, but yeah, you're going to need the authorized people to represent for joint intent.
Okay, another one on fair lending. How do online loans need to be monitored for fair lending?
Well, no different than any in-person loan or over-the-phone loan. You need to make sure that you're not discriminating based on the prohibited factors and characteristics that are out there. There's about 8 things that you can never consider. Steer clear of those and be consistent with everything else. You'll be fine. I know it's easier said than done, right? But you got a loan policy. When you follow the loan policy, you're going to be fine. You're going to have exceptions though. Now, if you're an online loan company that doesn't ever have exceptions, the job's a lot easier. But if you have exceptions, they need to be monitored and controlled. So it applies just like it would anywhere else.
In calculating flood insurance and the appraisal does not list replacement cost value, can we use the replacement cost value on the hazard insurance or flood insurance policy?
This is a deep topic. You need to come up with a good faith determination of value. Can you use that in part? Yes, but normally hazard insurance isn't exactly the right amount. It is something that examiners often will look at and say good enough because who knows better. I'm trying to make this as short as possible, but the problem is, like, if it has a basement, those things are not given a dollar-to-dollar value for hazard insurance, whereas flooding absolutely, hurts basements, foundations, footers, all those types of things. So it's a tool, but it shouldn't probably be the only thing you use. I'll leave it at that. Insurable value is about an hour-long topic that we do a webinar on, and I'm actually developing a new one on how much insurance do I need, and it's yet to be announced, but I'm trying to come up with all these scenarios. In fact, I see some other ones here in the Q&As along that same lines. It's a tough topic, and I empathize with all of you that are trying to come up with these exact answers.
Okay, back to TRID. Do you include owner's title insurance costs when it is optional in the 10% tolerance bucket?
If you are, did they say it was optional again?
Yes, they do
Okay.
say that it's optional.
So it's optional. It's going to be in section H on the loan estimate and ultimately section H on the closing disclosure. So that means there's not a tolerance tied to it, but it still has to be made in good faith. So no, the option, if it's optional, it's going to be, you still have to give your best, you still have to do your due diligence, come up with the number, but it's an unlimited tolerance as long as you meet that bar.
Okay, this one's on advertising. Would or could an email advertising be considered an electronic advertisement with Regulation Z's triggering terms in mind? In other words, can an email use hyperlinks for one-click away trigger terms on a HELOC?
Unfortunately, no. Emails are like a newspaper ad. They can print it out, and so it doesn't qualify. It's TV, radio, those types of things that are electronic. Sorry.
Okay, another TRID one. If we take online mortgage applications, but we do not provide a field for the property address, are we inviting scrutiny from examiners? Some lenders do this based on the reasoning of sequencing application information being allowed.
The last part of the question answered it. You're allowed to sequence or stagger how you collect things. So I can, in other words, I can set up an online platform that purposefully does not ask for one of the 6 items. Now, be smart with it. You're going to want to have their name because you want to know who they are and you want to have some contact information, but you could leave one of the other 5 out and claim that you don't have enough to have a TRID app yet, because that thing that's in TRID that says you can manipulate how you collect things. Now, you got to be careful. You can't discourage somebody from moving forward. That's a Reg B thing. So yeah, there's a fine line between staggering or manipulating the process and then stepping over and discouraging someone from moving forward.
And Jared, let me just, I'm not disagreeing with you, but you can't say, no, don't tell me that, right? I mean,
correct.
Yeah. So you don't have to ask, but if you get it, you got it. And so that you could leave that out on your application online. My opinion is I think it smells, but it's technically legal, right?
Correct. And a lot of lenders do it just like the questionnaire. I mean, it's not my game, but a lot of people play it.
Okay, back to HMDA. For a HMDA reportable loan, the amount of income reportable is what we relied on to make the credit decision. What if the income amount was incorrect? Should it be updated for reporting?
Boy, it's whatever you relied upon. So if you made that decision and denied somebody, let's say, and then later on you found out it was incorrect, I mean, I don't know how you change that. I'm going to give it depends on this thing. So, I mean, Jared, you applied and I had this income, and then I find out actually, like at closing, you bring in some final tax returns or something, and we find out it's more. We've already made the decision. So I would say you still go back to this decision made. I'm trying to think of a scenario where you would update it, and I suppose there could be, but it's whatever you use to make your decision, what you relied upon. And if you've made the decision, you've done. I mean, right, with that part.
I wonder if they're going for like a secondary market scenario where there's I submit to like
Final.
DU preliminary, and then
But again, didn't we already make the
there's a
decision?
final DU decision.
Sorry, but didn't we already make the decision to say yes to you, and then you bring in some updated information? We've already made the decision.
I think they could argue that it's preliminary and the final decision wasn't until DU ran through the last time.
There'd be a good point. If you're saying we have a preliminary decision and then we get this secondary, yeah, that could be. And so when you get that final decision, then I would say that's the new income number.
And they did include that in this case, the underwriter stated that because the customer qualified with the lesser amount, they went with it.
Sounds to me like they relied upon then that first income.
So, okay, back to TRID, and I believe this one is on the written provider list. Should your written list fees match how the fees are ultimately disclosed on the loan estimate? And should the fees have title in front of the fee descriptions?
Well, let me do this. You don't have to put fees on your shopping list. And if you don't have to do something, I recommend you don't. Most providers these days will allow you to eliminate that field. And the reason I say that is exactly the reason this question has been asked. It's causing problems and inconsistencies. So if you put fees on your shopping list that correspond to a service that's also on your loan estimate, they should coincide with one another. And if they don't, you're going to have to explain that some way, or you're going to have an error. As far as, do they have to have the word title in front of it? When it's listed on the loan estimate, it has to have the word title. And then Diane, correct me if I'm wrong, the description from the loan estimate has to be, is it exactly the same or similar? I don't remember the wording exactly to the shopping list.
Yeah, I think the commentary or the regulation uses the term correspond. So
Make them match. If you don't make them match, you're asking for people to ask questions and dig further, and that's just not what you want.
Okay, back to Regulation B and joint intent. What is the best way to prove joint intent when an application is taken by phone or when the box on top of the application was missed on a paper application?
Yeah, it's tell your story. So Diane called and said she and her husband wanted to apply for a car loan. If I write that down, joint intent is done. I've always recommended having some type of forms like that you would have the customer sign, and maybe I grab it and I say something like per phone, and then, something like that. So who called, who were they representing? That's what you want to document.
Okay, we have one on finance charges. Are fees collected at closing for items such as final surveys and title updates finance charges on construction loans, since the fees are collected for service to be performed after closing?
Oh boy. I have a cheat sheet that I normally go try to seek out, and it's on my computer.
And there is the thing about like life of loan flood insurance for after closing, but
inspection fees.
Yep.
That would all be included.
We're sitting here, blowing this all from memory kind of stuff too. So 1026.4.
There you go.
And,
I think it's C7.
C7 is residential stuff, right? But the after closing part, there might be a C7, then a commentary. I'm going to ask maybe like Tina that is on our team, maybe she can look into that quickly and find out an answer. I don't know that I feel comfortable shooting that one off the top of my head. And
I don't
apparently,
either. I will say there are several finance charts out there that are free. The OCC has had one for years. Bankers Online has some. There's a lot of free resources out there where you can go read up on that.
good.
Okay, back to TRID. If we have a refinance, do we need to disclose homeowners insurance in the prepaid section if the borrower already has insurance in place and we have proof of it?
Well, having insurance in place doesn't necessarily matter on a refinance. I mean, obviously you want that from a safety and soundness perspective, but the answer to the question is this. We'll call it the renewal, is the renewal for the insurance that's currently in place, is it going to be due and payable between when the application date was taken and the first payment due date month? If the renewal is going to be due in that window, then you're going to disclose it on your loan estimate. If it will not fall in that window that is app date to first payment due date, then you don't have to include it.
Okay, Hamda. On the secondary market, they require a 10-day, and they call it a PCV, an employment verification prior to close. Therefore, can we really have any approved, not accepted applications if they didn't have a planned closing date or if that 10-day check hasn't been completed?
Yeah, I don't know that it has to do with the closing date. It's, can you say you have final approval where you have fully vetted the people? And it sounds to me like you've given a preliminary approval and then you're waiting for this final verification. So could you have approved, not accepted prior to that? No, you have to have fully vetting, fully green lighting, I like to call it, the applicants. And that final piece comes in, then you would have it. Okay, if assuming it's still good. But prior to that, no, you could not have approved, not accepted. Preliminary approval doesn't count for approved, not accepted. Let me put it that way.
Okay, another one on fair lending. Can you offer discounted rates or fees based on the length of a customer relationship or customer relationship balances, if defined?
Absolutely you can, but here's going to be the trick. Are you ensuring, let's just pretend that Dave and Diane and I are all on the same team. Do we all have the same roadmap that we're following all the time? Because if we're not following the same roadmap and Dave's the senior lender because he's been here the longest and he's got the grayest hair, he gets to have negotiated rates and give discounts to everybody. But Diane and I, we haven't been here very long and we want to stay here long like him, so we don't ever deviate. That creates problems. And so where there's a lack of consistency, a lack of a roadmap, that's where you're going to have problems. So absolutely you can, but you got to spell it out and then be consistent.
Okay, back to joint intent. For a joint intent that is done over the phone and documented it, would you still have the customer sign the form at some time, such as closing, or is this not necessary?
It's not necessary from a compliance or regulatory standpoint. I like to call it the belt and suspender method. So to meet the compliance standpoint, it's at the time of application. So over the phone, did it, that appeases my examiners. But let's just say that Jared said, my wife and I, we went over to this and I wrote that down. And then in he comes dragging his wife along and she really doesn't want to be there. And I can tell. I'm going to say, even without that scenario, I'm gonna always try to get joint intent signed and say, Jared, Tina, this is what I understood you wanted. Is that correct? So, the first time I see them. And the reason I do that is civil liability. And we've actually had some cases. I was an expert witness in one and we lost because the husband said or whatever, but she claimed I didn't want to, and there was no evidence as part of it too. So belt and suspender method, not necessary for regulatory compliance, but for civil liability, I would if I was the king of your bank. But you'd have to decide if you feel there's pros and cons.
Okay. If we complete a change in terms on a loan secured by a home and we finance any closing costs instead of having them paid in cash, does this trigger anything in regards to truth in lending or right of rescission? Can we use a change in terms to extend the loan and payment terms, or do we have to consider it a refinance?
Ooh, there's a lot there. Let me take part of that. Closing costs, no matter how paid, are not rescindable in the sense that that's new money. So we charge $1,000 to do this and your loan balance is 100. So now it's 101,000. That isn't rescindable. Closing costs, that part of it. there's a little more to this question. Did you get some of the other parts, Jared?
No, that was the part I was concentrating on.
Oh, I took the easy one then.
Yeah.
Let's repeat that again,
Go
Diane.
to the second half of it, yeah.
So the second half is, can we use a change in terms to extend the loan and payment terms? Or
yeah.
do we have to consider it a refinance?
Okay, so let me take that. If you're going to rip up loan A and replace it with loan B, that's a refinance. If you're going to take loan A and attach something to it, a modification, extension, whatever, a launch, whatever you want to call it, that's not, for the most part, disclosable. When it comes to HMDA, it comes to truth in lending, it comes to RESPA, those types of things. You can't go from fixed to variable. You can't go from closed in to open in, things like. There's a couple exceptions, but otherwise you could pretty much do anything you want through some type of modification. And does that make it rescindable? This is crazy. Only if you're adding their house to the transaction. It's one of the examples in right of rescission. I've never seen a loan officer do that. So anyway, I hope we've covered there were several questions in that one.
Let me jump in. That's a topic we get questions on quite frequently, whether it's things like this, a live session in a bank, our review team's in there. Dave and I, for the first time last year, we did a 1-hour refinance renewals and modifications webinar that is available on demand in our store. That stuff doesn't change too frequently. And so even though it's in the store on demand, it's going to answer your question and a lot more on this topic, and probably would be extremely beneficial for your commercial lenders that probably do that more frequently.
Yes, and joint intent and flood, and then not just truth in lending, and it's every reg is on the table, because some things you are going to need to do again: joint intent, flood insurance, but not truth in lending and RESPA and HMDA. So there's a lot to clarify there, and we really explain what you can do, not so much what you can't do.
Okay, back to TRID. If the sale contract requires the buyer to use a specific closing agent, does this count as the borrower shopping for the service? The agent is on the bank's approved list of closing agents, but is not the usual service provider on the initial loan estimate.
All right, so when you provide a loan estimate, if you're going to let them shop, you got to provide a shopping list. You have to put at least one person on that shopping list that's able to provide the service. Okay. The answer to this question is simply, if they go out and pick somebody, either them individually or by way of their realtor through a purchase agreement, somebody that's not on the bank's list, they shopped. If they end up with somebody that was on the bank's list, they didn't shop, whether they picked or their realtor picked by way of the purchase agreement. If you let purchase agreements dictate, you're giving them the option to shop. The only way they actually shop is if they or their realtor pick somebody that's not on your list.
Okay, another joint intent. Do we need joint intent if you have a borrower and 2 guarantors, or would you only need joint intent for the 2 guarantors that applied together?
It depends on what capacity those guarantors are. If they're voluntary guarantors, you absolutely need them. One guarantor and one applicant, if you will, voluntary triggers it, because that's 2. If it's a mandated guarantor, you go, what do we mean by that? Officers, directors, shareholders, or partners of an entity, you can make them guarantee, then you don't need joint intent. So it depends on how those guarantees came to be. Did you require it, or were they voluntarily provided?
Okay, and we do have another one on joint intent. If a loan officer notates on the app, joint intent verified verbally, do you feel this is sufficient?
If the application was taken by phone or dropped off or sent in or something like that, yes. If the application was in person, why wouldn't they have marked it? But even then, it doesn't have to be. So Jared, I'm going to use you. You're sitting across the desk from me, and I'm the loan officer, and I say, now, so who's all applying? And you say, okay, and I just write down, Jared said. That technically, they don't have to mark those boxes. That's the biggest fallacy. You have to have evidence that this is what they wanted. And if they filled out the rest of the app, it's going to look a little odd that they didn't fill that portion out probably, but it's an appearance thing.
Yeah, to me, it's no different. I mean, there's a lot of times these days where loan officers they have the application electronically in front of them on their screen, whether Dave's sitting across from me or he's, down the road in his house. If I go and X the box that Dave indicated he's implying jointly, that's no different than me picking up my pen and writing down Dave verbally applied joint.
Right.
It
The
doesn't
whole
make a
thing that
difference.
stinks about this is what's the point of joint intent is that I'm not twisting your arm. So the unscrupulous lender that does that can just manipulate those boxes. And we all know that, hence it creates all these questions, but it's not a regulatory requirement.
Okay, back to HMDA. Would the following transaction be reportable? Purchase of a lot with a dwelling that will be torn down completely and built new. The funds will be used to purchase, demolish, and full construction. Does it matter if the borrower is a consumer or a builder?
Oh, if they're a builder, then I would call that like a spec house loan. And it's a business operating loan. And so if they're buying, tearing down, and building a spec house, I'm going to say that that's not reportable. That's the business they're in. A little bit different because the example I know is for them to construct, but they're going to bulldoze out. If they're not a builder, if it's me that's doing that, then I'm buying a house. It's kind of like the rehab loans, flash and dashes. Those are all reportable. I would report this though as a purchase because they're purchasing not only the house, they're also constructing, which is a purchase for HMDA. So either way, I'm back to a purchase. I would report that for non-builders. Jared, do you agree with the spec house part? That's a little bit out on the limb.
I was just going to throw a monkey wrench in this and say,
please.
you know, make sure everybody heard that Dave said that's a gray area because there is a carve out for spec home builders. This is not quite the exact same peg you're trying to fit. And so if you had reported that as a purchase, I'd probably go along with that.
You better be consistent on how you're doing this. And if you have people that are doing that, you're either going to always report them or never report them. I'm in the camp, but this is one of those round peg square hole things in HMDA. And I'm in the camp of spec houses are out, even if there was something there, but it's gray.
Okay, when we report discount points on the loan estimate and closing disclosure, do we need to prove in the file there is a direct correlation between the fee being charged and the rate actually being reduced?
All right, Section A, loan estimate and or closing disclosure. Doesn't matter which document we're talking about. If you have points listed in line 1, so directly below the subtotal, the first line, you have to give a percentage of the loan amount and then the dollar amount for points. Any points listed there, it's on you to be able to demonstrate in your loan file that for the point that you're charging, that the customer's paying, that they received a reduced interest rate. If you can't demonstrate that, you might think, oh, it's a one-off, or not a one-off, it's just a minor violation. It's not. It actually has been something that has been part of consent orders and been a restitution item where they've had to refund based on unfair, deceptive, or abusive acts or practices for something where the consumer thinks they're getting a reduced rate and you're not really giving it to them.
Okay, when doing a note modification to extend the maturity date, would a new escrow analysis and statement be required?
If you're truly doing a modification, restitution lending, all that's not, you don't have to give new disclosures. So the escrow account, you would not need to know. With that said, depending on what I'm modifying, I might want to reset the escrow account because you're changing so many things. You could wait though until the anniversary date. You could do a short year statement is what I'm getting at. Not a regulatory requirement, but it might be prudent to do so.
Okay.
You know, we've talked a lot about escrows today. One of the things that we do is an escrow webinar that's not just about RESPA. We pull in truth in lending, flood insurance, and I'm missing one, I'm sure, but
the payoff.
We do all of those in one place. And so if that's something you need some help with, check it out.
Okay, we actually have another escrow one. If we have proof that a customer homeowner's insurance has been canceled, may we use the funds in an escrow account to pay for force-placed homeowner's insurance?
Sure. So I guess I'm gathering they weren't escrowing in for insurance? Is that what you're assuming? So they've set up an escrow for what? Just taxes only, maybe?
Yeah, or maybe the borrower, I'm not sure, I guess.
Okay, so I'm going to have to make some assumptions here. They're escrowing only for taxes, and the borrower's paying insurance, and then they canceled it. Can we use the money from taxes to pay their insurance? Yeah, and what I would do is set up an escrow right now for the start. I'd change their escrow that, listen, you're outside of the loan provisions here. So we're going to start escrowing going forward, and I would give them a new initial, if you will, that says here's taxes and insurance. So you want to make sure that your collateral stays insured, though. Yes. So can you pull? I'm still a little bit. I'm buying some. Can you pull from an escrow account because it's really their money? Maybe. Let me put it this way. Maybe I should say no, but you're going to want to get that insurance paid, and then set up an escrow account going forward for that. That's probably the correct answer. That's the beauty of doing these spontaneously. As I start to answer, and sometimes I go, I'm not sure I agree with what I just said. So, Jared, anything to back me up?
Believe it or not, our hour has flown by, and
Yeah.
I know that everybody listening is busy and they've got customers, and we need to let you all get back to what it is you all do best, and that's serve your customers. But give me just a moment here as we close out. We answered, gosh, I have several questions here. We weren't able to possibly get to all of them. There's 3 times as many questions as what we answered that were in the queue. Let me do this. If questions are something you have about compliance, that's what our team tackles every day. We've got different packages we can put together for you. If you check out our website, give us a call. We'd love to be your trusted partner for ongoing consultation as it relates to your compliance matters. With that, let me go back to Dave and Diane. Anything before I close this out here? I've got a couple closing announcements, but anything?
Yeah, I'm going to add on. I called on Tina to say, did you on that whole post-closing finance charges, and she's did some said she cannot find anything specific to that. So that's big questions. I think what I do is I'd run them by our examiners and just say, what do you think of these? They're pretty unique. But Jared mentioned too, there's some tables out there. I bet Tina looked at them. I actually was doing that too. I couldn't find that specific situation. So sorry to not, to punt a little bit on that one, but that, or give us a call and we can research it and try to get a better answer for you.
All right. Well, thanks, Dave. Let me do this. Our next forum is already scheduled. It's out there. It's going to be May 6th, 2021. That's going to be our deposit Q&A. You can register today. I'm sure our team's put a link out there. It's also at the end of your packet. So get registered. It's just like this one. We'll answer as many deposit-related questions in the time frame. There's going to be a survey that popped up either separate browser or behind this window. We'd love for you to just take a couple moments and just answer those questions. It won't take you probably more than a minute, maybe even less, to give us a little feedback on today's program. Otherwise, with the recording here, we're going to process that as quickly as we can and get that back out to you. Again, there's no cost to that. You'll get an email when that's available for download. We'd love it if you'd rate today's program. That gives everybody an idea of whether or not it's something that might fit what they're looking for when they go to our website. With that, on behalf of all of us on our team, we want to thank you for stopping by today, and we're going to let you get back to you and your customers. Thanks again.